The cost of housing today is just straight up expensive. Over the last few years, we have seen the value of homes climb to all-time highs. And on top of that, we have also seen interest rates be raised substantially at the same time. And here's the big problem I am seeing. It would be reasonable to assume that when interest rates lower, we see an increase in the price of the average home. And that's because as rates lower, it allows more Americans to qualify for a bigger mortgage, increasing their buying power and putting positive pressure on the housing market. And that's actually exactly what we saw after the financial crisis in 2008, obviously after the initial dip, because in order to stimulate the economy, the Fed actually ended up lowering interest rates to pretty much all-time lows, which allowed the housing market to recover and even exceed where it was at very quickly. And it's also reasonable to assume the opposite when it comes to the relationship and correlation between interest rates and housing prices, which is when interest rates go up, it becomes more expensive to borrow money. Americans are qualifying for smaller mortgages, which would lower pressure on the housing market, and it would do that to such an extent that we would expect housing prices to lower. And we're not seeing that, and that's the problem. Since 2020, that relationship is not what has actually been happening in the housing market. During the pandemic, the housing market reached all-time highs as the supply dried up due to people not leaving their homes, and there was also a lack of new housing construction since the global supply chain needed to actually build these houses was severely impacted. And on top of that, interest rates were lowered dramatically to help boost up our economy in order to prevent a recession. And those actions from the Fed did end up stimulating the economy, but it did result in a housing boom, and it did lead to some of the highest inflation that us Gen Zers and millennials have had to live through in our lifetime. So since then, to counteract that inflation, the Fed is now taking the opposite approach, which is to raise interest rates to slow economic growth, thus hopefully reducing the amount of inflation or increase in prices that we're seeing. But with this increase in interest rates, we did not see the value in homes drop as dramatically as one might expect. And that has put us in a really tricky scenario where homes are pretty close to their all-time highs in terms of valuation. They've dropped a little bit, but not much. And on top of that, we also have higher interest rates than we've seen in more than a decade. And those are really combining to create a home affordability crisis in the United States. And I feel like as I'm on social media and on TikTok, I actually see a lot of Americans blaming the baby boomers for this. And there's a lot of complaining that boomers bought their house 30 years ago for a tenth of the price that it's worth today. And they complain that they just stay in those homes, they don't move, and they just sit on the equity. And I personally have felt like some of that criticism towards the older generation has been a bit misguided. I don't think we can just look at one generation and fully place the blame. I think there's just a lot of pent-up resentment there. But I also did not have the data in front of me, so that's exactly what I wanted to look into in this video. So let's dive into home affordability over the last 40 years so that we can fully understand what is going on in the market. Did the boomers really have it as good as we think they did? Let's take a look, and we're also going to dive into the factors that are actually increasing home values and keeping housing so unaffordable. And we'll also talk about what you can do to alleviate some of that burden for yourself. And real quick, make sure you hit that subscribe button. It really helps out the channel. And again, I really appreciate it. So thank you. Like I just mentioned, there's a lot of contention and resentment from the younger generations that's directed towards the older generations. There's a perception out there that the generations that came before us have had it much easier and have created a system that's made it impossible for the younger generations to succeed. And again, I don't believe that. I wasn't buying it. So I wanted to take a look at the data. And using data from the US Census Bureau and the Motley Fool, I went and calculated the ratio of the median US home price to the median household income for each decade starting in 1980. And I'll share that data right here. And I also just want to explain this chart really quick. So we have the year, we have the median household income, and we have the median home price, all in the first three columns. Now in the fourth column, we have the ratio of home price to household income. So for example, the average price of a home was 3 times higher than the average salary in 1980. And then in the fifth column, I wanted to demonstrate what that would look like today if we had the same ratio that they did under the given decade. For 1980, we already clarified houses were 3 times more than the average income. So if houses were 3 times more than the average income today, then the average house would be listed at $226,000. There's my explanation of the table. Now let's analyze it. And just looking at the data, we can see that house prices did increase at a faster rate than average household income. So housing did get more expensive relative to what people were actually bringing in. Again, in 1980, the median house price was roughly 3 times more than the average household income in the United States. And again, if that was true today, the average home would only cost $226,000, which sounds a lot better than the actual current average of $420,000. So if we are only looking at this from the perspective of average home prices, then yes, it is easy to say that homes today are more expensive than they were back in the 80s. However, if that was all we looked at, then we would not be looking at the entire picture. Let me ask, when you look at your own personal situation on purchasing a home, what are you thinking about? You're most likely considering mortgages and mortgage payments, right? And the truth is that a vast majority of Americans are going to need a mortgage to purchase their home. And because of that, interest rates also have a huge impact on home affordability, which we need to factor into our analysis. So I went and I added historic interest rates to our data, and I did that by calculating the median monthly mortgage payment and comparing it to the average monthly household income. And you can see the ratio between the two for each decade in this chart. This chart shows us exactly how much of Americans' monthly pay was consumed by their mortgage payment at each decade. And I honestly think the results here may surprise you. So let's start in the 1980s. And remember, housing prices in the 80s were much smaller compared to average salaries than they are today. But with that being said, interest rates were much higher back then than they are right now, almost by double. Can you even imagine having a 14% interest rate on your mortgage? And that's something that you need to consider when you're comparing your situation to the situation of the boomers. Was the price of their home lower compared to the average income? Sure. However, the interest on their mortgage payments was also much higher, and they wouldn't see lower interest rates for a couple of decades. If we take a look back at our graphs, households with mortgages were paying more than 40% of their monthly pay towards their mortgage, which is very high. It's almost to the levels that we're seeing today. So it definitely was not all rainbows and sunshine back then. And so many people make it seem like that. Now, when we take a look at the year 2000, we do see a significant shift in home affordability, as now the average household only needs to allocate 34% of their monthly income towards their mortgage payment. And I still think that's a little high, especially because you have to remember that this percentage is calculated using their gross income, not their take-home pay. But still, this is a substantial improvement over what Americans were seeing before. And things get really crazy between 2010 and 2020. Between the Great Recession and right now, we were operating in a period that saw some of the lowest interest rates in the history of the country. This led to a very quick recovery from the financial crisis and also led to one of the biggest stock market bull runs in US history. Here, interest rates are around 3 to 5%, and we see that impacted houses as the price increased. However, even with that, the average monthly mortgage payment made up a much smaller percentage of the average monthly income, at only 28 to 24% roughly. So even though the price of houses was much higher at this time, those with mortgages from 2010 to 2020 had it much easier than people who got their mortgages back in the day. But that brings us to 2024, which I'm sure you've been looking at as soon as I pulled this graph up, and that showcases the dilemma that I mentioned at the beginning of this video. Since 2020, interest rates have risen dramatically, and that was done to combat the increased inflation that we saw from the pandemic. But even with that, the value of homes has remained at a high level. And if the average American were to go and buy a home today, we would see that mortgage take up almost 47% of their monthly income. So you are not being deceived. Housing today is pretty much just straight up unaffordable. So you're not wrong, but I do want to challenge you. Again, I see a lot of blame being shifted towards older generations, but they were dealing with a lot of the same issues that we're seeing today. Homes were actually almost just as unaffordable for them as they have been for us. And yet somehow they made it through just fine. So next, let's talk about why we're in the housing situation that we're in. Why are home values more expensive even though the cost to borrow money to buy them is higher than ever? Well, let's discuss just that. It really all comes down to supply and demand. Now, demand is naturally lower than it was just a couple of years ago. Because prices have risen, it's become relatively unaffordable, and it's just priced a lot of potential home buyers out of the market. So it seems like there are less people who are actually looking to purchase a house today, which would normally lead to a decrease in home prices unless supply was also very low. So let's look at supply, which is really the main issue. We simply just don't have enough homes right now in the United States. According to an article from the Wall Street Journal, we have a housing shortage right now in America of 7.3 million homes. And this problem was made even worse in 2020 as Americans found themselves at home more often than ever. Plus, many people found remote careers, meaning that even if they landed a new job in another state, they did not have to move for that job. So there's just a lot less turnover in the housing market than there used to be. But when you really boil it down, the main issue is that our population continues to grow and new homes being introduced to the market just are not keeping up. According to the National Association of Home Builders, 2024 will see roughly 988,000 new single-family homes built and introduced to the market. And in 2025, we'll see 1.03 million homes. However, according to them, we need to be building 1.15 million homes to even make a dent in the national housing shortage. And to make sure that picture is clear, that means we need to be building over 100,000 more homes than we are. And that's the key issue. I also see the common misconception that the price of housing is being driven up by the increase in institutional investments over the last few years. In other words, people think Wall Street is coming in and buying up a majority of the homes that are available, which is also reducing the supply. And while investment firms did increase their purchases in 2020 and 2021 in this sector, it's not the leading reason why housing is so expensive. If we take a look at this chart from housingwire.com, we can see that the percentage of homes owned by investors has slightly increased since 2020. But it has not dramatically increased over time, and this percentage has remained about the same for the last little while. So while I cannot conclude that investors have had no effect, it does seem like this reason may be blown a bit out of proportion. So to summarize everything we just talked about, housing is relatively unaffordable today. And that is mostly due to the housing shortage caused by lower turnover and insufficient new builds being introduced to the market. But so what? What can you actually do about it if you're looking to purchase a home or if you're just looking to make a housing change in general? Well, let me start by saying make sure you get the right people in your corner. Make sure you have a great real estate agent who is good at their job and has your best interest at heart. And I am not a real estate professional, so make sure you always do your own research before you make any big financial decision like purchasing a home. But I can offer this advice, and that is to be patient. I see a lot of people my age who are very anxious about purchasing their first home. And this doesn't mean that they should not strive for that, because ultimately that is a good goal to have. But when you put too much pressure on yourself and you rush into something, you're more likely to make a bad financial decision. And just because housing is more expensive than ever does not mean that you can justify spending beyond your means when buying a home. I like to have the guideline of not spending more than 25% of your monthly take-home pay on your housing expenses, whether that's rent or whether that's a mortgage payment. And I'll be honest, most Americans are gonna have a hard time buying a home today that fits within those parameters. But you just have to stay patient and realize that the market will eventually level out. Remember, if you look back on our charts on housing affordability, this is not the first time that average mortgage payments have consumed over 40% of monthly income. You have to remember that our economy is cyclical and that things will balance out eventually. Now, I'm not a wizard, so I can't tell you exactly when that's gonna happen. I can't tell you exactly how it's gonna happen. I don't know if that's gonna be from a decrease in home values or a decrease in interest rates, who knows? But if you keep saving up for a down payment, you stay patient, and you keep looking for the home that's right for your situation, your opportunity will come along eventually. And that's gonna do it for this video. Let me know what your thoughts are down in the comments. What do you think of the current housing market? Do you disagree with anything I said in this video? Let me know. Hit that subscribe button. And again, we'll see you in the next one. Thanks.